Ted Oakley, managing partner and founder of Oxbow Advisors, and also author of multiple books, including your newest book, Second Generation Wealth. It is so great to see you again, Ted, and great to welcome you back to the show. We always love having you on, so really appreciate you taking the time again.
You bet, Julia. Good to see you.
It is wonderful to see you as always, and this audience always loves hearing from you. And gosh, Ted, I know we had you on earlier this year, but it was the last time we had you was right before the inauguration. I remember now. It was like the couple days before the inauguration. So I don't know, 100 plus days here. So much has changed since then. So let's kind of just start where we always start, more of that big picture macro view. I know you're one of these guys that looks at the more of the micro and the stock picking, but we do tend to start with more of the big picture macro view. So let's start there. And as you know, Ted, you can take all the time you need to set the table.
Well, you know, Julia, we've deteriorated quite a bit since that last time I talked to you in terms of a lot of things, not just one thing. But then when you brought in the tariffs and the talk of tariffs, actually, that brought in another whole spectrum to look at here. And one of the things I talked about January 1 was that at the beginning of the year, everybody was still really complacent after the fourth quarter. And actually, they're still really complacent. I've seen no panic selling or anybody worried about anything. But, you know, this is one of those times when if they'll look at what's going on underneath, and it's just everything. That's just, I mean, you can look at real estate, you look at profit margins on public companies, you look at trade. There's so many things, shipping. There's a ton of things right now that are not working, that are really deteriorating. And I think it's yet to catch up in the market. But I believe that's where we are right now.
When you say that you're still seeing the complacency, can you explain that? Like, what does it mean to be complacent? What does that look like? Because I reckon a lot of folks they might not think that they are complacent when in reality they are. So what does that look like?
Well, this is what it really looks like. If you look at the AAII, American Association of Individual Investors, they're very bearish, but they haven't sold anything. You go look at the assets, they still have everything. What that means is, yeah, they're worried about it and they're thinking about it, but they're not afraid of it. When they really get afraid of it, which is usually at a low in the market, that's when they sell. You know, they do a lot of selling. So, you know, on the one hand, you can have soft data that says, you know, I'm concerned about it, I'm bearish, but have you done anything about it? Which is no, you haven't done anything about it. We don't see that. I talk to other money managers the same way. People are not really doing that, which means that they probably think that, yeah, it's just a hiccup. I'm going to ride through it right now because that's what you should have done it the last 15 years. And maybe this time is different. It probably is, but that's what I call complacency. They don't do anything about it.
Mm-hmm. Well, that's a good point. Okay, let me ask you this. You're someone who, I know you as someone who keeps that balanced portfolio. You're someone who has liquidity, dry powder on hand. You have taken advantage of and benefited from downturns in the past. I think 1987, the tech bubble, financial crisis. When we saw what happened with markets and the sell-off, curious, were you buying anything? Were you doing anything? I would just be so curious.
Well, at times we buy things. We will even buy things. If they get cheap enough, we'll buy them whether the market's up or down. I mean, there's things we've bought and a few things we've sold during the quarter. But by and large, we still have the same amount of treasuries we had in the first week of the year. And really, in all three of our strategies, relative to the market, we're doing really, really well. I mean, we're having one of the best years ever relative to what everybody else is seeing. But that's because we have a lot of liquidity, I think, as much as anything. And the companies we do own and what we do own in those strategies have worked out well too. But, you know, what happens in these things is most people don't really have enough liquidity. That's the one thing I notice overall right now. So they're probably just going to go with the market, whatever the market does.
What is typically, in your mind, the appropriate amount of liquidity to have?
Well, I'll answer that in two ways. It has a lot to do with age. One of the things we notice now is that this group of people that are over 55 or 60, particularly over 60, they have very little liquidity relative to what they would have had before. And they're all invested in stocks. They have some. I'm not saying they don't have any, but they don't have enough. That's what I'm saying. They don't have enough. And I'll give you a statistic. If you look at, and the Fed puts this out, if you look at household wealth and equities, Fed puts it out, it's about 55, 58% of household wealth and equities. Well, in August of 1982 it was 8%. Just give an example of how deep they are into these assets. And so what happens, they don't carry enough. But I think, like, if you're 30 years old, you don't need as much liquidity because you're funding it all the time. You got a lot of time. You can afford to keep buying into things. You got a long time to go. That's one thing. You probably don't have as much money in it. But once you have liquidity events or you have a lot more money, then you need to start thinking about, one of the books I wrote was called The Psychology of Staying Rich. And really rich people, I'm talking to people with more than $500 million, usually have about a third of their assets in some sort of liquid form, okay? Doesn't have to be in the market or buy, but it's some sort of liquid format. And the reason they have it that way is because, number one, they don't have to be able to live off, $3 million. So they can do something with it. But more people ought to learn that lesson with smaller amounts of money and keep more. It gives you a lot of, and it gives you a lot of ways you can go when things get bad. And the people with the money are the ones that will make the most money.
Yeah. Let me ask you from the demographic bit. Sounds like maybe boomers, they have too much in stocks right now.
Well, I think they do. I mean, we turned down on a number of investors that come through that are, say, over 65 because they have 85 or 90% of their total liquid assets in the stock market. Well, as a fiduciary, I can't take that on because if something happens, I'm the one that's responsible, and I'm not going to be responsible for them to being 85 or 90% in the market because they shouldn't be that. I mean, that's not prudent for them to be that way. They're not very balanced at all, but they've been used to this last 15 years. And it's created a situation where people are sort of drunk on the last 15 years and they can't see it until it really something happens that's bad.
I think that's a good way of putting it. They're sort of drunk on what's happened the last 15 years. And we know that, things don't always repeat. It's not always the same. It could be different. This time could certainly be different. Let me ask you this. I wanted to find it in my inbox, but I couldn't. I do often get like viewer notes. I do have a viewer note that I was looking for this particular question someone had asked, but when I was finding it, someone wrote, love your show, watch them all, and I discovered you years ago, particularly Ted Oakley, because I find myself nodding yes on everything he says. I thought that was pretty nice when I was searching for it. But what I was looking for was one of my viewers had asked about dry powder and liquidity and kind of like knowing when to like deploy it. I wish I could find this question because they had a bunch of them in there. But I guess like you can have all the dry powder in the world, but the psychology, I guess, or there's fear that keeps people from deploying it in the sell-off. Like, what have you learned as an investor? Like, what works, what doesn't work? I don't even know if there's even an answer to the question, but yeah.
Well, that's a good question. For us, we look at the valuations on companies. That's what we look at. If a company gets cheap, and we run all the numbers, we scan, we really look at about 250 companies that we would like to own if they were cheap enough. But that's what we look at. I would tell you though, and you'll find that's interesting, but I'll give them a really simple way to look at things. Okay. But the Value Line Investment Survey, which is not expensive, and we spend a lot of money on on research, but we also take Value Line for this reason. They have a front page every time that says, based on what we see, the potential for the market increase over the next 18 to 36 months, I believe it is a number. And markets are really high. That number is only like, 30% potential, maybe 25%. I've seen it lower than that. When markets get really, really cheap, that number goes way up to like 100, 120%. I mean, you have tremendous potential. And that's just based on the valuations of the companies just in the Value Line survey. And the reason I'm saying that to people, because that's a cheap way, inexpensive way to know when you're really in the zone, okay? And it's something I've looked at for years. But when that gets up to 100% or 120%, you're in the zone. Or buying, I should say, because they're looking at things like that, you see, all the way. And And I say that out there. I can give them a lot of ways to look at knowing when to buy, and there's no perfect time. I think the biggest thing they have to realize, though, is you have to scale. Nobody knows enough to say, okay, this is it, we're going to buy in. And what we do is we'll put in 10% of the cash, then we'll put in 20. Give you a good story. We had 40% cash in 2008 or more. We put in 20% when the market had gone from 14,700 to 8,800. That's a big drop. We put 20% in thinking we really did pretty well. By March of 09, the market was 6,600. It lost another 25%. Oh. So we put in another 20%. Now, obviously, 09 ended up being the biggest year we'd had since 03. It was a big, big year. That's because we had liquidity. But what I'm trying to say is, don't try to win the war all with one push. You know, try to scale into things you do. And what you'll find is that over time, that'll work really well for you.
I think that's such a good lesson. And I just found the question from the viewer. His name is Mike. Part of that question, because I think you answered most of it. It's a series of questions, but he asks, like, if you are 50% liquid, what conditions determine the speed at which you deploy capital into purchasing assets? When fully invested, what percentage of cash do you keep on hand? Are there conditions in a declining market that would cause you to stop buying assets? So those are just a couple of the other questions on the topic.
Sure. Well, that's a good question. I mean, for us, when we're fully invested, we think things are so cheap that, you know, we've got it in. We're going to be somewhere around 6 to 8% liquid. That's all we're going to have, you know, because we'll have put the rest of it in. Now, if we're like we are now, about 54 or 55%, you know, we're picking off companies now at 1% numbers. Okay, like we'll buy a company. You know, we bought a couple of fertilizer companies, you know, in the last month at 1%. But we won't do what we won't do is go in and say, okay, this is it. And we're going to buy, you know, we're going to put in 25% out of the 50 and make it work. You have to scale in, and nobody's good enough to be able to say this is it. But when you find the valuation, like we can find companies that are really cheap. I mean, really cheap relative to where they've been the last 10 or 15 years. We'll buy some of that company. No matter where the market is, we'll buy a little bit of it. Will we buy a full position? Probably not, you know, but we're going to start it anyway. And that's how you get into it. But I think people get fidgety by answering the question, this gentleman, 50% cash, and they think I'm going to miss something. Well, what I've found is you never miss it. There's always a new market, always a new train that leaves the station. So don't worry about it. You'll be able to buy something.
You might be in good company when you look at like what Warren Buffett's been doing with his cash stockpile, and yeah.
Well, that's a good one to watch. I mean, you know, he's made his errors too, mm-hmm. But over the years, I've watched him for a long time. But one of his errors he doesn't make is he usually has a lot of liquidity at lows in the market.
So when we were talking at the beginning of this episode, you're talking about deterioration. So are you expecting like the stock market to decline? Are you expecting more of a recession? Like, what are you anticipating, or what are you looking out for? What is kind of the risk on your radar?
You know, Julia, that's the reason that's a hard question is because you could not have a recession, but you can have what we expect, which is a twofold. We expect a shrinking of corporate margins, company margins, profit margins, and at the same time, a shrinking of the multiple that people pay for those. That's a twofold hit right there. Sometimes you just get a market sell-off and the earnings stay the same and the multiple shrinks. But this time you get both. We think you get both. We think the earnings are overstated for the rest of the year, and probably the multiples too. I mean, even now we're still selling at 21 times, you know, future earnings. I mean, that's an expensive market under any circumstance. And so if you had a reduction in the S&P earnings from say 270 to 240, and the multiple went back to 16, you got a 4,000 S&P. I'm not saying that's happened, but that's what you have to think about. That's different here. And then the other thing is that I don't think anybody's capable, for sure not us, of factoring in all the ramifications from I'm basically talking about the supply side of the economic side right now because of tariffs. The supply situation is what's going to really, I think, get messed up. If you look at shipping right now, coming in from China, just shipping in general. So, I mean, all these ports are cratering right now in terms of business, and we see it. And you also see prices going up, and you see prices in the U.S. going up before the tariffs hit because they know they can raise them. So you got a sort of a double whammy coming in. Whether it causes a recession, I don't know, but I bet it could get down to zero growth anyway. And if you do get that, the market's not going to be where it is today.
Yeah. But you could also see that decline in the market, but not necessarily see a recession. That's what I'm hearing.
Oh, yeah. No, you could get it. I mean, my guess is to go from the growth we had last year to say a zero level, to me, that's just as bad as a recession. In other words, it would get into the marketplace no matter what, and it would probably create, some really good buys. I mean, I think people, again, they're still chasing yesterday's dream because if you look at this market move the last 3 weeks, whereas other people are feeling like the bottom's in and we got to get on this thing, we're like, no, they're giving you another chance to get liquidity. You should take it.
Okay, so that's an interesting point too. Like that wasn't necessarily a bottom then from your perspective. Like there's a window here to get some liquidity.
Well, it may have been the low for the year. I don't know, but I don't think this is the beginning of a move unless something drastic. Mm-hmm. Even if things change, I mean, these agreements on, if you look back over the last 10 years, any agreement we had on tariffs or any of those things, they're minimum 18 months in the making, even if they're good, even if people get along. So I can't see anything that's going to come out of that's going to be that plus. But I just think that people they want it to be that way. They want to be sort of like the old system so much right now. They can't stand it. And so they just keep buying that dip. And when they get a little move like this, they feel good. I made some money. But then it turns around. A bear market does this to you. Then it turns around, takes you back to a new low. And you're like, gosh, I shouldn't have done that.
Oh gosh,
that's the way these things work.
It's not just like, okay, we decline, now we can go back up. You can go back up and go back down and go back. Yeah. Which that probably takes a pretty strong stomach to be able to handle that. We are recording for folks watching and listening. We are recording in the afternoon. The markets have already closed on Wednesday, April 30th. So last trading day of the month, and we got the GDP print today as well. You kind of mentioned it, but how are you thinking about the broader economy going forward?
Well, you didn't see it much in I think the first quarter was okay on the GDP because when it really started happening was in April. So by the time you get in and start printing in April, May, June, I think you'll see a different look than what you saw in that. And that was, once those prints come out, they're just history. They don't mean a lot necessarily at that point. But I feel like that when that news hits like that, people think, well, it's okay, but they don't realize you hadn't seen what's been going on in say from the third week in March until now. And, you could tell it today. They tried to run them back up at the end of the day because they're trying to mark up at month ends. I know what's happening, but it just there's no saying they paint the tape, but they still do it.
Mm-hmm. You have to be prepared. It sounds to me like just listening to you from an investor perspective, you have to be prepared for a scenario, not saying that's going to happen, but you need to be prepared for this. Possibly you could see 4,000 S&P 500. That is a scenario you have to be prepared for. How are you thinking about preparing? Like, how do you prepare for that?
Well, you don't know that's going to happen. So you have to be balanced. We always talk about balance. And if you got balance, you're okay. Like, for example, if you have enough liquidity, for us right now, liquidity's got to be somewhere between 45 and 55% in treasuries. Mm-hmm. Not because we're trying to time the market, but trying to time the values. If we had a lot of super duper values right now, we'd buy them, but they're not there. A lot of these companies are too expensive, and you see these companies announcing, and then their stock just gets murdered. Well, that's a sign of the times you're in, and that's what happens in these times. And eventually, the whole market catches up with it. So, what you have to do that is you have to say, if I'm not seeing the valuations, if the valuations come in at 4,500 on the S&P, then you take it. You look at companies and you can get a good look at it. If it comes in at 4,000, my guess is it would go lower than the last round, than the 4,800, because there were too many people called a 4,800, 5,000 bottom, and they thought, hey, I got it. We're right. And I don't know, there's an old saying on Wall Street, don't pick a level of the market and don't forecast time when it's going to be. And so we don't do either one.
Yeah. I mean, it's interesting. You have seen a lot of companies and CEOs, they've withdrawn guidance. So I can't imagine that this is the end.
Well, it doesn't look that way. And I'm going to be really surprised if the buyers over the last 3 weeks are not feeling worse 3 or 4 weeks from now.
And a lot of them were retail, right? The buyers?
A lot of retail.
Yeah.
And that's where I think people, and a lot of retail, you see it because they're buying the single day options, they're buying the 2 times, 3 times leverage long Mag 7 stocks, which these Mag 7s they're getting beat up. I mean, they're getting hurt.
Mm-hmm.
And yet people keep buying them, but they keep going down. Look at Tesla today. I mean, that's what happens to them. But they're also buying the leverage pieces of all of this. And I think that shows you that fever is still in there.
Yeah, it's an interesting point. And that's not to say, like, as you mentioned, like, you guys are buying things too. You're making investments. You're not doing nothing. Did I hear you? I don't know if you mentioned it. Consumer staples, or like what are the opportunities right now that are interesting to you, or at least have been attractive lately?
Well, we own different things, but the consumer staples that we own and bought in the last 60 days, 90 days, are like Colgate for us. Unilever is a great stock for us. We don't think they'll be affected much by everything. We look at those kinds of things. We already own Kimberly-Clark. But in addition to that, what we'll look at is something like if you look at in the last 3 or 4 weeks when they were cheaper a month ago, we bought some Novartis and some AbbVie, and people were like, they're going down. But see, the numbers got really cheap, and so we bought some of those. And if you look at them today, it looks like they're really beating the market now. It's not because of anything other than the fact they got too cheap. That's really what happens. And so there's things you can buy, but there's also things. We own quite a bit of gold miners and gold in really all 3 strategies, but I'd be a little hesitant to chase that group right now because they've moved up so much. I mean, they've been a big mover for us in the last year, but you go the other way when things get like that. You don't have to necessarily sell out, but you look at things on a valuation basis is what you do, and certain things are really cheap. And some of them are, people, it's hard for individuals to do this, but some companies are cheap for a reason. That's because they're lousy. They've got a real low multiple because they have a lot of debt. They don't do the right things, poor management, all sorts of things. Well, just because they're that way, you don't buy them. You have to factor everything into that thing, debt to equity, management, where you think they'll be the next 3 to 5 years. Well, for us, gold is a currency hedge. So the bullion gold we own in 2 of the 3 strategies. The miners we own in 2 of the 3 strategies, and 1 strategy has both. But in the most conservative portfolio strategy we run, which is basically bulletproof, we carry 5 or 6% gold because it's a really good currency hedge. In other words, over time, and when you own gold, the bullion itself, you can't really trade it per se. You just need to own it. It's going to go through periods where nothing happens for a few years, and that's just the price you pay. And there'll be periods like we've gone through here, in the last 3 where it really does really, really well. Now the miners are different. The miners, you trade the miners and they'll get really cheap. They're really cheap now, actually. They're still very cheap. And they'll catch up with the gold price eventually. And when they do, you have to cut back on the miners. It's not something you hold year in and year out, like the bullion is. The miners are trades. When I say trades, I mean, we'll hold them for 3 or 4 or 5 years, but that's probably max, because people will get excited about it. They run them up to, they were super expensive in 2011. And if you look at the miners then relative to today, and we were to go back to those multiples, the miners would still go up another 2 or 3 times just to get to that multiple. That's how expensive they were.
Back in 2011.
Yeah.
I got to tell you something. The first time I bought gold, I won like some money, like at an entrepreneurship contest, and I put it all in gold in, I want to say like August or September of 2011, which at the time was like the peak, but I forgot about it. I just didn't do anything with it. And now I got my statement recently and I'm like, okay, well, that's nice now. But
see, you just had to hold through it.
Yeah.
And then it went into that dip period all the way through the end of 15 and going into 16. But you just had to stay with it, because if you look at gold over a time period, go look at the 25 years compared to the S&P for January 1 of 2000 until now, and gold's beating the S&P. Now, did it every year? No, but you had to stay with it.
Exactly. I just didn't do anything with it. I still haven't done anything with it. It's still sitting there. But it was kind
of... maybe now is even more important, because you've looked at debt to GDP of this country and where we are we're so far over in that area that you probably have to really want to stay with the gold.
Yeah. Okay. When you say currency hedge, can you explain what you mean by that? And is that like the loss of purchasing power in the US dollar? Does that tie into like the de-dollarization theme? Can you explain that for me?
Well, if you were to take the dollar valuation and you took it, let's go back 30 years ago, and you took the dollar on a valuation basis, and you'd see, and you come until now, and you risk adjust it for inflation, right? Okay. Then you find out that it's gone down. It's lost so much purchasing power that entire time. If you take gold and think about something like this. If you could buy a house let's say 5 years ago, you bought a house with gold, and the house was say the average home price, really 20 years ago, took you 04, it was 170 or something like that. And it took us X amount of gold to buy it at that time. And today, the average home price is 380, 375, something like that. That same gold is about $1.1 million.
Oh.
See? In other words, it's beating the number. But you wouldn't think about it like that, because when you go to buy something, you don't think, well, I'm going to spend this much gold to buy it. But when you think about it on a long-term basis, you thought, well, I could have bought XYZ. Like if you look at a gold bracelet today that's $10,000, you could have bought it 30 years ago for $1,200, maybe $1,500. I mean, in other words, it's got a markup in for retail. I know that, but the gold itself is driving the price too. So that's how you look at it. And now you have to realize that we are now at the worst point in history as far as a country, because we're so indebted that every country and a lot of people are losing faith in the U.S. And so they're going to keep selling the dollar, selling the assets here, going other places and buying gold, because they're like, well, I'm going to depend on the gold. I can always cash the gold. I can't always cash that dollar. And I suspect the dollar will continue to go on down.
Yeah. Interesting. Speaking of like US dollar assets as well, treasuries, you want to be careful about like where you are on the curve. I take it like you don't want to necessarily be in like longer dated treasuries then, given our situation.
Well, I've said this before. I said it last year too. I don't think you can buy long-term bonds, long-term corporates or long-term treasuries and really make any real money out of them, because they don't pay enough for you to, like, if you look at a 465, 470, a 30-year treasury, well, that's not much, for that. And what we're doing, at least, and we would recommend people to do, keep those maturities less than 2 years. Have it. You can go out and lock it up if you want to, but try to keep your maturities less than 2 years, because That leaves you in control. Once you buy a 30-year bond or a 20-year bond, you're out of control. Somebody else is in control. If you're buying 2-year bonds and less, 1 year, 6 months, whatever, you're in control. And so once you lose control of your assets, you're in trouble.
Yeah. Let me ask you one more question before we get into the book as well. You were just kind of mentioning like maybe more of our fiscal picture here in the US, our debt situation, our deficits. It's not a pretty picture. Like I haven't even looked at the debt clock, even with Doge. Like, let's see, where are we today? 36.7 trillion.
I started to say it's probably close to 37.
Yeah. How do you think about our picture, or maybe more of our future here? Like, yeah, how do you think about that?
Well, I don't, I'm obviously all American and I love this country. But I have to tell you, this country, in my opinion, okay, physically, we're talking about money and the way they operate, has seen their better days already. And there's really not much of a way out of this other than some pain of some sort or the other. You're not going to be able to snap your fingers and get back to where everything's back to some sort of normalcy. But I think the best days of what I call Pax Americana, where we were the leading country and people listened to us and our finances were straight and all of that, I think that's history. I think from now on, as an investor, you have to realize I can't always depend on the U.S. to be the lead dog here. There's other things going on in the world and other people that have a different point of view right now. And I think that's what people probably ought to be thinking about.
Yeah. It's a theme I've heard brought up on this show quite often lately. All right, Ted, we have to get into your book, which just came out, Second Generation Wealth. What do you want for your kids? And I read it. I got the Kindle version. It's an easy read, which I love about your books, because you can get through it in one sitting. Okay. So inheritance, one of my takeaways, this is like one of these really challenging topics. You work with a lot of high net worth individuals, really successful people who might even be like, this is their first time like coming into success and a lot of money. And they have kids, grandkids, and you have to have this conversation, or I guess really, how do you have that conversation with your children around money? Because we know money, yes, it can be great and a force for good, but it doesn't always, it can be a curse too. It doesn't always mean happiness. So let's just kind of start there. Like, how do you even approach that subject?
Well, the first thing I would say, Julia, and hopefully you've experienced this too, is that the only way that you come to really value money is to experience the lack of it. Okay, so you can have all the conversations you want to have with a kid, but what you have to realize is that they have to have some sort of situation, and you shouldn't talk to them when they're teenagers. I mean, I really disagree with the financial planning community and all that, and they want to bring in people at 14, 15, 16, 17 years old and show them all the family wealth and the portfolio and all that thing. These kids are too young, okay? And once you do that, you take away all of their ambition and you take away their ability to want to really do well in their own life. And so what I recommend to people that have a lot of money, I said, this is going to be hard for you to do, but you can put your kids through college. You can even buy them a car if you want to. But once they're out and they're done, you need to put them out. You need to put them out on their own for 7, 8, 10 years on their own, really on their own though. You're not, a lot of people try to fake that and they're buying 50, 60% of what a kid's and a spouse is doing, the young ones. I said, that's not on their own. On their own is where they've got to pay for everything. Yeah, you can get them a Christmas present, nice one, if you want to give them a little cash, something. But I'm just saying they have to make it on their own. There's some real benefit of that. Number one, if you don't ever have any adversity, you're not going to have any character in your life. And number two, if you don't experience this money thing about it, I got to pay for this myself. Okay. Then you're never going to really appreciate money because it was all handed to you. You didn't have to do anything. And people come to me and they say, I don't know what to do about these kids. They're not doing anything. And I ask the question, what are you doing? Well, we take care of them. We do this, that, and the other. I said, well, that's a problem. Okay. Your problem is you're taking the easy way out, which is to fund everything they're doing, when you should say, look, I love you. You're on your own. Okay.
Yeah.
Now you go get a job and you start paying for everything you do, where you live, your insurance, your food, your clothing, etc. And then you go figure it out. Okay. Because that's what's going to happen here. I'm not going to fund you anymore. One of the things you get from that is the ability of those young people to stand on their own 2 feet, and you just created for them self-esteem, which is what these really rich kids don't have. You've showered them with all this money. You took all their self-esteem away from them. They have no self-esteem. They spend all their life trying to be purposeful. They try to take their money and buy their friends and make sure, I have a lot of money, so this is why people like me. That's not what you want. You want people to like you as a young person because they like you individually, not because you're buying all this and you're doing it. And I've talked to too many of them, and they're lost because the money came on and they didn't do it. The great ones, though, and there's a lot of people, by the way, have done it the right way. And then what they do is, and when you talk to your kids about money and big wealth, by the way, you do it one-on-one. You don't get them all together in a family meeting. Every kid's different. Every one of them is going to accept what you say differently. You don't have to tell them everything, but usually I say by the time they're 34, 35, and they've been out in the world, you can talk to them. You can start talking about your family wealth and what it all has to do with it. And you need to live by example. I mean, if you're flying around on a private jet all the time and you're in Aspen and overseas and going to France in the summers and you're taking these kids with you, you just messed up.
Yeah. Well,
wherever that kid's going to go, they ought to be working in the summer, number one. Secondly, they need to be flying Southwest.
I love that.
Okay.
Well, as you mentioned in the book, don't bring the teens to the table, but in the 30s, as you point out, that's the time where you can have that conversation, and they've had that struggle. Okay, let me ask you this. We've talked about your own background. You grew up in abject poverty in Georgia, and you look at you today and you're a successful man. And I imagine, is it hard though? Okay, you go from poverty to success. Is it hard to not want to give your kids the whole world, things that you didn't have? How do you kind of navigate that part of it, or making, wanting to shower your kids with all these things, but also not, I don't know. I don't know if it might be a really bad question, but I'm trying to think how, if someone comes into, they didn't have wealth, they come into wealth, and then it's you want to give your kids what you didn't have. How do you
Well, that's
balance
a good
that?
question, because a lot of people will say, I don't want my kids to have it as hard as I had it. Actually, that's a wrong answer. You want them to have it hard for a while. You want them to have adversity. You want all that for that, because that's what builds that character. That's what builds their ability to stand on 2 feet. And for me, what I did is, because I knew work goes a long way toward that. And for my children, I have 2 kids, and both of them, a boy and a girl. And when they were basically 13, 14 years old, I took cash money and gave the whole summer's salary to one of my friends in cash. And I said, you work them just like they were a regular employee. You pay them on Friday. And then when they get to be 16, they can get a regular job, which they all did. They had to work. They all had to work every summer. I would not let them travel to Europe and lay out by the swimming pool, the country club, or something like that. They had to work. Okay. That's what builds that. So that when they get out of college and you say, hey, okay, now you got to work full time. Well, they've been used to working. And I see these kids come out of college and never have a job. I'm like, you got to be kidding me as a parent. You didn't make them work. And so what do you expect them to do? I mean, they've never had to do anything. And you don't have to be a hard charger to do that, but you have to think about the child or the kid. What do you want for them? That's my point. Mm-hmm. If you go the easy route and you just fund everything, then it's easy for you, but you're ruining them.
It's a good point. You talk about the importance of setting an example too, and money can be a force for good and it can do so much good in the world, especially for others. When you think about the example you want to set and how to keep money from becoming a seed of unhappiness, because there are a lot of very wealthy people that they're not very happy. So how do you think about setting the example? Like, is just maybe even like everyday life, what are some of the things you can do?
You know, Julia, never thought about it, but Tolstoy in one of those writings said that happy families are mostly all alike, but unhappy families are all different in unhappy ways, different ways. I think that's true. But what happens is, I think with people, they forget about what's the objective here, and you can talk about, okay, I want to bring them into the foundation and let them see that, but there's more to it than that. I think what you teach a kid is this: everybody is equal in your sight. Everybody. If you can raise a child like that to say, you know what, these people that help you that do yard work, or housekeepers, or people that serve you at a restaurant, they're the same as you are. Don't look at it any differently. Okay, they're working hard, they're trying to make it, and if you can get your kids to understand that, then that's a part of philanthropy that makes a difference. And so if they see you do little things, I'm talking about, not put your name on the building, but little things like seeing somebody in need and just nobody will ever know it, but out of pocket, do something really good. Those are the things that a child will see you do. Okay. It's just an example. And, it doesn't have to be in lights. In other words, you don't have to have your name put on a building that you gave, 50 million. A lot of people are going to do that. Don't get me wrong. But what goes a long way for your kids is by example, to see that you look at the world in the right way and you appreciate people for what they are. And you'll go a long way by just having that one quality in business and in your personal life.
I really like that, Ted. Ted, I have to say, you're always such a delight to have on this channel, and I know this audience loves having you on, and we welcome you anytime you want. And at some point, we have to do another in person because that was another fan favorite. And before I let you go, let's take a moment here to let folks know about the work that you do at Oxbow Advisors. Let them know about the book, where they can pick it up and get themselves a copy. And any parting thoughts, anything that you would like to leave this audience to think about, the floor is all yours.
Well, I'll get to the website and everything, but what I would tell people today is you have to realize you are on your own, okay? You're on your own. And you need to think about yourself and how you're invested in what, in your age determines a lot of that. So if you're 70 years old or 75 years old, you need to think about that next 15 years, you'll be 90, all right? You need to look at your assets and make sure that stuff's structured correctly, because that'll have a big impact on your life, not only economically, but socially. And for young people, same thing. Look at what you have. And I'm just saying, you're on your own, and don't always trust everything that comes off Wall Street. For us, you can really find everything about what we do. Our market letter, we do a lot of videos and different things about how we're looking at the market every quarter. And that's all at the website. The books we have, though, are everywhere. They're on Amazon, Apple. You can get those, any of those outlets, Barnes and Noble, I have those. And I'll tell you, I've always written design things so you can read it in 2 hours. The point of a book to me is to get the point across. It's not.
Yes.
I read so many books, and I'll only get 25% of that book is what I wanted. The other 75 is
Morgan Housel talks about that. Yeah.
Yeah. And so I want to get the point across. And so I make it such that busy people, which most wealthy people are busy, they can get that done in a couple hours and really get the point.
I love it. Well, Ted Oakley, founder and managing partner of Oxbow Advisors, thank you so much for being so generous with your time, all of your knowledge, your wisdom, your ideas. Really appreciate you taking the time and looking forward to our next conversation. Thanks again, Ted.
You bet. Thank you, Julia. Hello everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe and you'll see more of what we do here at Oxbow.